Do you ever get confused with the different types of life insurance that are out there? Stay with me because today I'm going to break them down and show you the difference between each. Hi, my name's Jeremy Smith, and over the better part of the last 16 years I've been an agent, a manager, an owner-operator of my own brokerage, and for the last 7 years I've been a business coach traveling the country helping agents and agency owners grow their practice. Stay with me because I'm going to try and help you grow yours. If you've been on YouTube before, then you know the game. Please like, comment, hit subscribe. So welcome to Life Insurance 101. There's three main types of life insurance: term, whole life, and universal life. I'm gonna break down each one of these three. Let's start with term because it's the easiest to understand. Term is a life insurance policy that has a specific premium for a specific death benefit for a specific set of time. Of all the three insurance options out there, term is the cheapest insurance there is. It normally goes in variations, but normally it's 10, 20, or 30-year terms. The longer you have the term, the more expensive the premium's going to be. The reason I say it's a lot of times an insurance policy bought by younger people is because once you get older, let's say you're maybe 55 years old, that's probably about the latest you're ever going to be able to buy a 30-year term insurance policy for. You most likely 20 years is probably the most at that point. You get up to 60, 65 years old, the most you may be able to buy at that point might be a 10 or a 15-year term. So the older we get, the less our options are, and therefore that's why a lot of times term is a policy for younger people. It's obviously the cheapest policy and life insurance policy you can buy as well. Let me move on and talk to you about the second type of insurance. A whole life policy is a permanent insurance. And typically people buy whole life policies for one of two reasons. Number one is to leave money to their beneficiaries or their estate. It's a policy that should always be there and never run out if it's written correctly. Unfortunately, too many times in my career have I seen policies that are not written correctly. One of the things about a whole life policy that it's supposed to do is the cash value is supposed to build in your accumulation stage when you're making premium payments. And the cash value is supposed to build up enough that when you get later in life, the cash value will pay the premiums on that policy for the rest of your life. So you don't have to make those premium payments when you get older and you're not working and the income is lower. Unfortunately, what I see all the time is that insurance agents in the past have written these policies and they haven't established enough premium for the client in the beginning stages of the life insurance policy, so therefore not enough cash value is built up through their later years in life, and therefore the policy explodes in their late 80s before a lot of people are passing away or dying these days. And so then what happens in that scenario is they've either got to make some huge premium payment to keep the policy alive, or the whole thing collapses and they made all those premium payments for nothing. This, however, though, is a huge opportunity for you as an agent because I'm telling you, there is so many policies that are out there right now that are going to blow up. And so you as an agent, just getting the basic information of these policies from your clients, what their premium is, what their death benefit is, how much cash value do they have in the policy, and taking that to your life marketer, you can be a hero to that client and replace that life insurance policy and write it properly so it doesn't blow up in their face. And the best thing about that is you don't have to talk them into buying it. They already have it. Your job as an insurance agent is just to find the problems and give them the solutions. The other reason people buy whole life insurance policies is to build cash value. A lot of younger people do this. They'll build cash value, make premium payments, and build the cash value through their accumulation stage so that when they get later in life, they can use that cash value themselves. Okay? It's a theory called the be your own banker theory, or be your own banker system. It's something I'm going to do a whole video just on that theory and that system. The logic, though, is this. The logic is that you build that cash value up in your life insurance policy and you borrow from it instead of borrowing from the bank, and therefore paying yourself interest instead of the bank interest. So the third type of insurance is called universal life insurance. I'm a big fan of universal life insurance, and mainly just because of the flexibility that this policy allows. It allows you as the agent to manipulate the cash value or the death benefit or the premium in order to make the goals of the client happen. For example, if the goal of your client is to leave as much money behind to their kids or grandkids or their church or their charities, then what you can do in a universal life insurance policy is you can actually build it to where the cash value builds super slow, super low, so the death benefit can be at a max. Okay, you can fluctuate those different buttons, kind of like the equalizer on your stereo. Just the opposite, I personally have a universal life policy, and the reason isn't so that I can leave a lot of money to my kids or grandkids in it. It's so that I can use, kind of like in the whole life policy we talked about, so I can use the cash value of it and borrow that money tax-free, interest-free, pay back myself. So my universal life policy, I've got a $200,000 death benefit, a $100 a month premium, but what I do is I do what they call super funding it. So I pay $500 a month into that premium. Therefore, not my death benefit, but my cash value is growing super fast. Therefore, once again, I can use that cash value when I need to purchase something down the road, like a car, rather than go in the bank to purchase that car. Again, the big value to me in a universal life policy is the ability to maneuver and manipulate those different levers. The flexibility of a universal life policy is the true value of it. So if you watch some of my earlier videos, a couple different videos, I talked about my agencies back in the day when I had an agency. We never sold a lot of life insurance. What we did do though is we replaced a lot of life insurance. And if you are really new to life insurance or you're new to this channel and you haven't watched some of my earlier videos, I want to teach you something that's super vital for you as an agent to understand. It used to be back in the 1950s, 1960s, when we bought a life insurance policy, it was based on about four things. It was based on our age, it was based on our health, it was based on how much coverage we wanted, and it was based on a mortality table, or how long we're expected to live. Well, when you buy a life insurance policy today, it's still based upon those same things. The difference, though, is that just these last few years has the insurance companies finally updated their mortality tables to represent that we're living longer, therefore stretching out the cost of insurance, lowering the cost of insurance. If you find a life insurance policy, I don't care if it's a term, a whole life, or a universal life, you find a life insurance policy that's older than, say, 5 or 6 years old, there's a really good chance that as long as they're still have their health, they can still qualify for a new life insurance policy, that you can replace that policy and give them more death benefit or lower their premiums, improve their policy one way or another, just with the stroke of a pen. And it's all because these mortality tables have finally been updated by the insurance companies to represent that we're living longer. So in your practice, I don't know what you do, whether you sell Medicare supplements or final expense, if you sell annuities, if you sell everything. Hopefully you're using a fact finder. But in your appointments with your clients, if you just simply ask the question, do you have life insurance, and then find out their death benefit, their premium, their cash value, and maybe their term, and take that information back to your marketer, you will find that a good percentage of your clients will give that information to you very easily. If you identify a problem, it'll be the easiest lay-down sale you ever had, and you'll be a hero to your client. I look forward to seeing you in our next video. I'm going to break down on our next video the last type of insurance that I think is the most overlooked product that we as insurance agents in the United States miss and don't offer.